Let me begin with a statement that may sound dramatic, but economics often turns dramatic precisely when we ignore the signals. Markets rarely move first and then justify themselves later. More often, structural change begins quietly and prices simply catch up. The discussion around silver reaching $65 is not a story of speculation alone. It is a story of structural demand, technological transformation, and a global economy entering a new phase where physical resources once again constrain digital ambition. For years, silver was treated as a secondary industrial metal, overshadowed by oil, copper, and lithium. That era is ending. Silver sits at the intersection of electrification, renewable energy, and now, critically, artificial intelligence infrastructure. AI is not a purely virtual phenomenon. It requires data centers, and data centers require massive electrical conductivity, energy efficiency, and heat management. Silver, with its unmatched conductive properties, becomes not optional, but essential. Here is the first hook we must confront. The digital economy is colliding with the physical limits of the real one. AI data centers consume extraordinary amounts of power. As these facilities scale globally, they demand not only electricity, but materials capable of handling extreme loads with minimal loss. This demand is not cyclical, it is structural. Once built, data centers do not disappear during downturns. They lock in long-term material consumption, creating a persistent floor under silver demand. Now consider supply. Silver mining has not expanded at a pace consistent with this surge in demand. Many silver deposits are byproducts of other mining operations, meaning production cannot be rapidly increased in response to price signals. This creates a classic economic imbalance: inelastic supply confronting accelerating, non-negotiable demand. When such conditions emerge, prices do not rise gradually, they reprice. This brings us to the second hook. Markets are beginning to recognize that $65 may not represent a ceiling, but a threshold. As AI infrastructure spending intensifies, and as governments and corporations race to secure technological dominance, competition for strategic materials increases. In this environment, prices are no longer set solely by industrial users, but by strategic buyers seeking guaranteed access. That dynamic changes everything. There is also a broader macroeconomic layer to consider. Inflation has reintroduced scarcity into economic thinking. Central banks can influence money, but they cannot print metals. As capital searches for protection against currency instability and supply disruption, silver occupies a unique position. Part industrial necessity, part monetary hedge. This dual role amplifies upward pressure in ways traditional models often underestimate. The idea of $72 as a new floor is not a prediction in the narrow sense. It is a recognition of altered fundamentals. When new technologies permanently raise baseline demand, price floors reset. This is not unprecedented. Oil experienced it, copper experienced it, and now silver appears to be entering a similar phase, driven not by consumer behavior, but by infrastructural necessity. The rapid expansion of artificial intelligence infrastructure marks a fundamental shift in how demand is generated within the global economy. Unlike consumer-driven cycles that rise and fall with income and sentiment, AI data centers represent long-term, capital-intensive commitments that lock in material consumption for decades. This is the first hook that must be understood once built. These facilities do not scale down when markets soften. They operate continuously, anchoring demand regardless of short-term economic conditions. AI data centers are not simply large warehouses of servers, they are energy-intensive industrial systems. Their performance depends on the efficient transmission of electricity, minimal resistance, and effective heat dissipation. Silver's unmatched electrical and thermal conductivity makes it uniquely valuable in this context. As processing density increases and energy efficiency becomes a competitive advantage, substitution becomes increasingly difficult. Copper may be cheaper, but efficiency losses at scale translate into higher operational costs, making silver economically rational rather than optional. Here is the second hook. Digital growth is no longer weightless. The common perception that software innovation reduces reliance on physical resources has been overturned. Each advance in AI capability demands exponentially greater computational power, and that power must move through physical circuits, connectors, and cooling systems. The digital economy is colliding with material reality, and silver sits directly at that intersection. This demand is also geographically diversified. AI infrastructure is being deployed across North America, Europe, Asia, and the Middle East, driven by both private competition and state-led technological strategies. This global build-out reduces the risk of localized slowdowns dampening overall demand. Even if one region pauses investment, others continue, reinforcing a steady baseline of consumption that traditional commodity models fail to capture. Another hook lies in time horizons. Data center investments are justified on multi-decade expectations of usage, upgrades, and expansion. Once a supply chain incorporates silver at scale, it becomes embedded in design standards and procurement contracts. This creates demand persistence that is resistant to price volatility. Higher prices may slow marginal projects, but core infrastructure continues forward because its economic logic extends beyond spot pricing. What emerges is not a temporary surge, but a structural demand shift. Silver is being pulled into the core architecture of the AI-driven economy, transforming its demand profile from cyclical to infrastructural. As long as artificial intelligence remains central to productivity, growth, competition, and national strategy, the consumption of silver tied to that infrastructure becomes a permanent feature of the economic landscape, reshaping price dynamics in ways that short-term analysis consistently underestimates. Silver's supply dynamics stand in sharp contrast to the accelerating and increasingly inflexible demand now shaping its market. Unlike commodities that respond quickly to higher prices, silver production is constrained by structural realities that make rapid expansion extremely difficult. This is the first hook that must be recognized at higher prices do not automatically bring higher supply. And in silver's case, the delay is measured not in months, but in years. A significant portion of global silver output is produced as a byproduct of mining for other metals such as copper, lead, and zinc. This means silver supply decisions are not driven by silver prices alone. Even if silver prices surge, producers cannot simply open new silver mines or dramatically increase output unless it aligns with the economics of the primary metal. This disconnect weakens the traditional price-supply feedback loop that many market participants still assume exists. Here is the second hook. Exploration does not guarantee production. Discovering economically viable silver deposits has become increasingly difficult, both geologically and financially. Ore grades have declined over time, regulatory hurdles have increased, and environmental scrutiny has intensified. Developing a new mine now requires extensive capital, long permitting timelines, and political stability, all of which slow the response to rising demand. By the time new supply reaches the market, demand conditions may have already shifted again. There is also a geographic constraint embedded in silver supply. Production is concentrated in a limited number of countries, many of which face political, environmental, or infrastructural challenges. This concentration exposes supply chains to disruption and reinforces scarcity during periods of heightened demand. When supply is both slow to respond and geographically constrained, price volatility becomes structurally embedded rather than episodic. Another hook lies in capital discipline. Mining firms, having experienced decades of boom and bust cycles, are increasingly reluctant to overinvest based on price signals they perceive as temporary. Investors demand capital returns rather than aggressive expansion, further limiting supply growth. This restraint may appear rational at the firm level, but at the system level it compounds scarcity. What emerges is a supply profile that is rigid, delayed, and resistant to rapid adjustment. When such inelastic supply meets persistent, infrastructure-driven demand, markets do not correct smoothly, they reprice sharply. Silver's inability to respond quickly to price incentives transforms it from a flexible commodity into a constrained resource, where scarcity is not a temporary condition, but an enduring feature of the market landscape. The movement of silver toward and beyond $65 is often described in the language of excitement and momentum, yet that framing obscures what is actually taking place. This is not a speculative surge driven by enthusiasm or fear of missing out. It is a structural repricing rooted in altered economic fundamentals. The first hook to grasp is this: speculation fades quickly, but repricing endures because it reflects a new understanding of value. Speculative rallies are typically fueled by leverage, short-term narratives, and rapid reversals. They rise fast and collapse just as quickly once sentiment shifts. What distinguishes the current silver market is the absence of these classic signals. Demand is being generated by long-term infrastructure commitments rather than short-term trading flows. Industrial users are not buying silver because they expect to sell it later at a higher price. They are buying because they cannot function without it. That distinction changes how prices behave. Here is the second hook: when demand becomes non-optional, price elasticity disappears. AI infrastructure, electrification, and advanced manufacturing do not pause because input costs rise. They adjust budgets, redesign margins, and pass costs through supply chains. This means higher prices are absorbed rather than resisted, allowing a new price level to stabilize instead of correcting. What looks like overextension through a speculative lens appears as equilibrium through a structural one. This repricing is also occurring in a context of constrained supply, which removes the usual pressure that brings prices back down. In earlier cycles, rising prices attracted sufficient new production to restore balance. Today, as supply remains inelastic, price signals do not trigger rapid corrective responses. Instead, they force a reassessment of what constitutes a sustainable price. The market is not overshooting, it is recalibrating. Another hook lies in investor behavior. Capital is increasingly distinguishing between assets driven by narrative and those anchored in material necessity. Silver's dual role as both an industrial input and a monetary hedge places it firmly in the latter category. As a result, price movements attract longer-term capital rather than short-term speculation, reinforcing stability at higher levels rather than volatility around them. What ultimately separates repricing from speculation is persistence. Prices hold because the underlying conditions that produced them remain intact. As long as infrastructure demand continues, supply remains constrained, and capital seeks protection from monetary instability, the market's reassessment of silver's value becomes embedded. The shift towards $65 and beyond is therefore not a temporary distortion, but an acknowledgement that the old pricing framework no longer applies to the economic realities now in place. Silver's role in the global economy is undergoing a qualitative transformation that extends far beyond conventional commodity classification. What was once treated as a flexible industrial input is increasingly functioning as a strategic resource, one whose availability carries implications for technological leadership, energy security, and geopolitical competition. The first hook is unmistakable. When access matters more than price, markets stop behaving like markets and start behaving like power structures. Advanced economies and corporations are no longer simply purchasing silver based on cost efficiency. They are securing it to ensure continuity of critical systems. AI infrastructure, renewable energy networks, medical technologies, and defense applications all rely on silver's unique physical properties. In these sectors, substitution is limited and failure is not an option. When silver becomes embedded in mission-critical systems, procurement shifts from opportunistic buying to long-term access planning. Here is the second hook: strategic demand reshapes pricing logic. Traditional industrial users respond to price increases by reducing consumption or seeking alternatives. Strategic users respond by locking in supply, even at higher costs, because the economic damage of disruption outweighs the cost of materials. This behavior introduces a scarcity premium that is independent of short-term demand fluctuations. Prices begin reflecting competition for access rather than simple production costs. This shift also invites state involvement. Governments increasingly view control over key materials as a component of national strategy. Policies designed to secure domestic supply, diversify sourcing, or restrict exports introduce non-market forces into pricing dynamics. These interventions reduce transparency and flexibility, reinforcing higher price floors as markets adjust to politically constrained supply. Another hook emerges in financial behavior. As silver becomes recognized as strategically significant, it attracts capital not just from industrial buyers, but from institutions seeking exposure to assets tied to long-term structural trends. This investment is not speculative in nature. It is allocative. Capital flows towards silver as a way of participating in the infrastructure of future growth, further tightening availability. The strategic classification of silver also changes how shortages are perceived. Shortfalls are no longer tolerated as temporary imbalances, they are treated as systemic risks. This perception encourages stockpiling and forward purchasing, amplifying demand beyond immediate consumption needs. The result is a market environment where even modest disruptions have outsized effects on price. As silver transitions into a strategic industrial input, its pricing becomes less about efficiency and more about security. Access, reliability, and continuity take precedence over cost minimization. This redefinition alters the behavior of buyers, investors, and states alike, embedding higher valuations into the economic structure and reinforcing the idea that silver is no longer just traded, it is contested. So when we hear that silver has reached $65, the real question is not how high it has gone, but why it may no longer be able to go back. AI data centers represent a long-term commitment to material-intensive growth. They anchor demand in ways speculation never could. In that context, the conversation shifts from whether silver prices are rising to whether the global economy has quietly accepted a new reality. One where digital intelligence is built on physical scarcity, and where silver is no longer just a metal, but a foundation.